Hi, this is CF Liu from howtofinancemoney.com. Now this video is about Philip Managed Account for Retirement. Match long-term savings with long-term investment. In summary, this is a video to review one of my business partner of Freedom, Philip Capital, which actually enables members to withdraw their account one EPF to be managed by a private fund manager, approved private fund manager by EPF, and in result of that, to maximize their EPF money investing in the stocks market of Malaysia. Now this is not a direct comparison with EPF returns, because you can't compare like that, because EPF actually you get that almost like mandatory 2.5%, and they invest in relatively low risk instruments, but stock is relatively high risk instruments. So but for those who are young and who wish to maximize their retirement money investing in the stock market, so this is what we call as a PMART, Philip Managed Account for Retirement. Now this video will actually reviews some of these performance of this investment option for the first half of 2013. Now this is the just hot from the oven, 15th of August. This is just the fun fact sheet, so-called, from the fund manager itself to review how's the performance for the first half of 2013. Now this I can't really actually let you download or actually send you this PDF, because if you are already a client for this investment scheme PMART, and also if you are a business partner or my clients or an investor with Philip, so you may get this fact sheet as well. So but I can share with you what this fact sheet is about. So PMART Performance Report 2013 Interim Performance Report. Now this report presents you with the performance of advisory and discretionary accounts for Philip Managed Account for Retirement, PMART, the name that Philip Capital used for EPF members investment scheme. Okay, there is this comparison. We deal with comparison of the two types of investment. When you withdraw your money from EPF account one, there's two mandates. One is advisory accounts. That means you invest your own EPF money on your own, where discretionary accounts are actually fully managed by the fund manager of Philip Capital Management, PCM. So what are the yardstick or the benchmark for PMART, right? So as you know, the first half of 2013, with the impending election, people are generally cautious. Then in the second quarter, actually just before election, you see that the market actually rises. So it's just a review of what has happened a few months ago as of the time of this recording. So we're going to skip that, and this is the performance distribution. Like in short, the discretionary accounts gain about 12.8% in just the first half, in this 6 months time of 2013. You can see the red bar over here, discretionary return 12.8%, where the KLCI return actually gains about like 5%, where advisory mandate return gains 7.2%, right? So discretionary mandate, as you see, 12.8%. There is some review of how the discretionary accounts actually outperform the KLCI benchmark index, right? So on fail. So okay, that's about it. So 12.8% is the return in just 6 months. And there's also a highlight of how the most or more than half of the advisory accounts actually perform better than KLCI, but more than about 80% of the advisory accounts actually underperform discretionary accounts. So this is not surprising, because Advisory account, you manage your own money, and most of us are like retail investor. We lack some of the resource of the fund manager in terms of picking the profitable stocks, and because fund manager, they are full-time into this, so it's not surprising that they actually do better than retail investor. But then again, a fair comment is, if a retail investor can actually perform better than a fund manager that actually performs full-time, I mean, if your stock picking skill is better than a fund manager, then I think by all means, I think you should be the fund manager instead. So, but again, advisory mandate is not too bad, meaning that you can actually maximize your return up to 7.2% in just 6 months. I mean, if you know how to actually pick stocks, and if you know how to maximize your EPF account money, so this is an option for you to do so. Now, and then there's this statement about the growth of discretionary accounts. Discretionary accounts are getting more popular because more and more retail investors actually putting the trust in the fund manager itself to actually invest or maximize their mandatory retirement money. So as you can see, there's a growth in the discretionary accounts compared to advisory accounts. Now, this would be the latest update for the performance of this PMART by Phillip Capital for the past 5.5 years, as illustrated by Table 2. So as you can see, in 2008, this part of one of the thing that always show potential clients or prospects. You say that because it's invested in equity, when the stock market drops, any accounts or any funds invested in the stock market will drop, but a properly managed portfolio will actually drop less. Okay, it will actually drop less than the stock market itself. So as you can see, KLCI dropped 29% in 2008. Discretionary account dropped only about minus 22.7% for PMART account. Now, if we actually analyze this, okay, this is the thing they want to look at. If we actually analyze this for the past 5.5 years, for the past 5.5 years, there is a complete bull and bear cycle. You can see that KLCI gained about annualized return 3.8%, whereas the discretionary mandate managed by PCM actually gains 9.2% a year annualized return. So it's in the positive. Okay, annually, taking into account a depression or economic recession in 2008, whereas they can show that the advisory account actually breaks even. Now, the other thing is that there's a comment by the fund manager to say that KLCI continues to be bullish. Right? There's some of these things like because due to Malaysian government dynamic efforts to boost the economy via the ETP program, as the removal of political risk after election, okay, the concerns of despite the concern of US-China economic slowdown and US Federal Reserve decision to taper off the monetary stimulus. So over the past 5.5 years, discretionary accounts managed to deliver a superior return of 62%, which is more than two-folds of KLCI 22.7%. Okay, and on the last page, you can see that it highlights again about 69.6% of all discretionary accounts have gained more than 80% in cumulative return for the past 5.5 years, compared to only 26.5%. Now this actually another point to highlight about the fund manager performance track record itself in actually making profitable returns for their clients and investor, because my money is also invested with them. So with this, I mean, if you ask me as a retail investor, I'm quite confident with what I'm seeing right now, and I'm going to just pump out some of my money into this PMART by Phillip Capital PCM whenever condition permits. So to sum it all, over the first 6 months of 2013, discretionary accounts have achieved a quite a good return of 12.8%, which is almost double of KLCI return of 5%, despite a relatively low equity exposure, while advisory account gained about 7.2% the same period, which is not too bad considering the 7.2%, or a lot of people, I would guess a lot of investors that participate or manage their own EPF account money and invested in stock themselves, they're actually quite a relatively savvy investor, because to be generated 7.2% in just half a year, it is no easy feat as well, right? But 90% of the discretionary account tend to outshine the KLCI and advisory accounts due to better diversification and stock picking strategy that focus on company with strong fundamentals. So that is it about the performance return for PMART by PCM, Philip Capital Management. Now, for further questions on how to participate in this scheme, you can actually contact me, drop me a mail, or just hit contact me at the top of my blog, and you'll see how we could help you to maximize your retirement money. Okay, this is CF Liu from howtofinancemoney.com. Ciao, I'll see you in the next video.